Imagine waking up tomorrow, checking your phone, and seeing gold prices suddenly crashing. Headlines everywhere saying, gold drops as interest rates surge. Investors panicking, some selling, some confused. And one big question spreading across the market, is gold losing its power? Or is this just another setup before a massive move? Because right now, something very important is happening behind the scenes, something most people don't fully understand, and that is the silent war between interest rates and gold. And if you understand this one relationship, you don't just follow the market, you stay ahead of it. Before we go deeper, make sure you like this video and subscribe to the channel, The Gold Report. Because here we break down complex market moves into simple stories that actually make sense and help you stay one step ahead. Now think about this. Gold has always been seen as a safe haven, something people run to when things go wrong. But at the same time, interest rates are controlled by central banks, and they quietly decide where money flows across the entire world. So what happens when these two forces collide? Let's simplify it. Interest rates are basically the reward you get for holding money in banks or bonds. When rates go up, you earn more just by saving or investing in safe assets. When rates go down, that reward becomes smaller. Now here's where gold enters the picture. Gold doesn't pay you interest. It just sits there. No yield, no income, just value. So when interest rates rise, investors start thinking, why should I hold gold when I can earn interest somewhere else? And slowly, money starts moving out of gold into bonds, into savings, into yield-generating assets. That's why, most of the time, when interest rates go up, gold struggles. But here's the twist, and this is where it gets interesting. It's not always that simple, because markets don't just react to what is happening. They react to what is expected to happen. For example, if the market believes that interest rates will keep rising, gold may start falling even before rates actually move. And if the market believes that rate hikes are about to stop or reverse, gold can suddenly explode upward, even if rates are still high. This is where most beginners get trapped. They look at current rates, but smart investors look at future expectations. Now imagine a situation where inflation is rising fast. Central banks increase interest rates to control it, but inflation still stays high. This creates fear, because even though rates are higher, the real value of money is still falling. And in that environment, gold becomes attractive again. Why? Because gold is not just about interest, it's about trust. Trust in currency, trust in the system, and trust in the future. And whenever that trust starts to shake, gold quietly starts gaining strength. Let's take a step deeper. There is something called real interest rates. And this is where the real game is played. Real interest rates are nominal rates minus inflation. So if interest rates are 5%, but inflation is also 5%, your real return is basically zero. And when real interest rates go negative, meaning inflation is higher than interest rates, gold becomes extremely powerful. Because now holding cash or bonds is actually losing value. And that's when investors start moving back into gold, not for profit, but for protection. Now think about recent years. Inflation rising, central banks aggressively hiking rates, markets reacting, gold moving up and down. It may look random on the surface, but underneath, it's all about this one relationship. Interest rates versus gold. But wait, there's another layer. The US dollar. Gold and the dollar usually move in opposite directions. When interest rates rise in the United States, the dollar becomes stronger because global investors move money into US assets to earn higher returns. And a stronger dollar makes gold more expensive for international buyers, which can push gold prices down. So now we have three forces connected together. Interest rates, the dollar, and gold. And this triangle controls a huge part of the global financial system. Now imagine a scenario where interest rates are high, but the economy starts slowing down. Jobs become unstable. Growth slows. Markets become uncertain. In that situation, central banks may start thinking about cutting rates. And the moment the market senses that shift, gold reacts fast. Because lower interest rates mean lower returns elsewhere, and suddenly gold becomes attractive again. This is why gold often rises before rate cuts actually happen. It's all about anticipation. Now let's bring this into a real-world mindset. Think like an investor. If you have money and you see high interest rates, stable economy, strong dollar, you might avoid gold. But if you start seeing cracks, inflation uncertainty, economic slowdown, possible rate cuts, suddenly gold starts looking like a smart move, and this is exactly how big institutions think. They don't wait for confirmation, they move on signals. Now, here's something most people ignore. Central banks themselves are major buyers of gold. Even while they control interest rates, they still accumulate gold reserves. Why? Because gold is not just an investment, it's a hedge against the system itself. So even the ones controlling the system don't fully trust it. And that tells you something very important. Now imagine this. Interest rates peak, inflation stabilizes, but debt levels globally remain extremely high. Governments cannot afford very high interest rates for too long because it becomes expensive to manage debt. So eventually, they may be forced to lower rates again, and when that happens, gold could enter a completely different phase. This is where long-term investors start positioning early. Not when everyone is talking about gold, but when the signals are still forming. Now let's talk psychology. Markets are driven by emotion, fear, and greed. When interest rates rise, people feel safe, holding cash, earning yield. But when uncertainty increases, fear starts taking over, and gold becomes the emotional safety net. This emotional shift is what creates strong moves, not just numbers, but behavior. And if you can understand that behavior, you can stay ahead of most traders. Now think about the future. What happens if inflation comes back stronger? What happens if central banks struggle to control it? What happens if interest rates can't go much higher due to economic pressure? These are the questions smart investors are asking right now, because the answers to these questions will decide the next big move in gold. Will gold break higher, or will it stay under pressure? The truth is, it depends on how this balance between interest rates and economic reality plays out. And this is not a short-term game. This is a long-term cycle. Now, as you watch the market, don't just look at gold prices. Watch interest rate decisions, inflation data, central bank statements, and most importantly, market expectations. Because that's where the real signals are. And remember, by the time news becomes obvious, the smart money has already moved. That's why staying informed matters. And that's exactly what we do here on the Gold Report. Breaking down complex financial moves into simple stories that actually help you understand what's really happening. Now, I want to hear from you. Do you think interest rates will go higher from here, or are we close to a turning point? And what does that mean for gold, in your opinion? Drop your thoughts in the comments, because the more perspectives we share, the better we understand the market. And if you found this video helpful, make sure to share it with someone who is interested in gold or investing, because this is information most people overlook, but it can make a huge difference. Stay smart, stay informed, and I'll see you in the next one.